A very good morning to one and all. Today we want to understand or get a clearer picture on one of the important aspect in international finance, that is derivatives. So derivatives, what do you mean by derivatives? That is the first fundamental question. The answer is here. It is nothing but, it is a financial product. So automatically it's product connected with finance. Now, what are you playing it? What are you doing with that product? The value of that product is derived from the value of another underlying asset. So, you are not actually buying or selling the asset. You are using a product whose value is derived from the underlying asset. Now, for example, you might have heard about some commodity markets. In commodity markets, let's take cotton. So, cotton is a product, or it is actually an asset. But you are playing on cotton called cotton futures. So you are either buying or selling cotton on a future market, but actually the value of that is derived from the underlying asset called cotton. So cotton futures is a derivative of cotton. Same way gold ETF, gold exchange trading funds. You are not actually buying gold. You are trading on the exchange on the basis of the value of gold. So you can actually buy 1 gram or 2 gram and then buy and sell. But you are not possessing gold. So this is the derivative, and we will try to understand a better picture down the line. So what can be an asset? We have already said that there is an underlying asset. So what all types can be that underlying asset? It can be an equity, it can be a bond or a commodity. So just 2 minutes before, the explanation or the example which I gave was on a commodity market, that is cotton, and the derivative is cotton futures. Now, what are the major derivatives available in the market currently? One I just told you, that is futures. Let's understand all. One is a forward contract, another one future contracts, third one option contracts, and fourth one swaps. Last session we had an introduction on how to understand the exchange rate, where we were talking about forward quotations and spot quotations. Now we are trying to understand the players, or what all techniques you use, what all derivative segments you take in international finance. In that, the same thing, but it is a contract. So you can go for a forward contract, or you can go for a future contract, or you can go for an option contract, and last but not the least, swaps. We are going to understand one by one now. Let's first understand currency futures, because ours is the topic, the major topic is international finance, and international finance is majorly focused on currencies. So first understand currency futures. What is that? It is a price of a particular currency. So whatever currency you have taken, that is a price for settlement. So on settlement, you are either fixing a price or you are telling this is the price. But when do you fix it? You fix it today, but the payment or the delivery is done on a specified future date. So you are taking a future position on currency, that is currency futures. What are the popular exchanges for currency futures around the globe? One is in Singapore, that is Singapore International Monetary Exchange, CIMEX. Another one is IMM, that is International Money Market, Chicago. We'll just try to understand something on IMM down the line, because there is something called International Working Capital Management. So it's all, the whole game is here. We'll come down to this in the future sessions. So once we have a fair idea about currency futures, that futures you are taking a long position or a short position on a currency after a specified date. But can we have more deeper understanding on the word futures? Here it is. What do you mean by a future contract? Future contract means that contract which are traded through stock exchanges. So automatically it is regularized or it is standardized. But how do you trade? Just like you have heard about real estate agents, just like you have heard about life insurance agents, same way there are called brokers. So brokers are there who are authorized as per the regulator. Who is the regulator in India? It is SEBI, Security Exchange Board of India. So there is some procedural aspects. So when a person qualifies all those things, automatically he will be a registered broker, and he can act as a broker for facilitating the investor to invest either in India's one of the two stock exchanges, big stock exchanges, that is either a Bombay Stock Exchange or National Stock Exchange. What are the features of a future contract, or what are the characteristics of a future contract? First one, it is standardized, which means you cannot have off-lot contracts. The quality and quantity of the underlying asset is standardized. So you will be specifying exactly what is the quality, what is the quantity of the underlying asset, then only you will talk about futures. So this is one of the special characteristics. Second one, there will be an expiry date, which means on what date you are taking the position. So if it is 2 months, automatically 2 months is the expiry date. And third most important, when and where the delivery is made. So these three indicators gives a very simple information that you cannot have haphazard information in a future contract. So that is one thing which is already mentioned in the first point, that is standardized, where quality and quantity is clearly mentioned. Second, expiry date of the contract is mentioned. Third, when and where the delivery is made. Automatically this is followed with the price of the contract, that is future price. Now how do they do? What are the activities? How the future contract gets executed? Normally what do they do is buyer and seller. There are two parties. One person is a buyer, another person is a seller. They prefer to close the contracts by reversing their positions, which means here the person who buys will take an opposite position, that is selling. The person who sells take an opposite position, that is selling. That is called reversing their positions. Automatically you get cancelled, your position gets squared, that is the word that is used. So automatically your contract get closed because you are taking opposite positions, or you are reversing your position, thus squaring the contract. Squaring means just nullifying the contract. What do they do? That's what I told you. Here it is written clearly. How do you reverse the positions? Buyers of a future contract sells another future contract. See, buy and sell. Now future contract will be the same standardized contract. Here if you are talking about coconuts, buying of future coconut futures, there it should be selling of coconut futures. You cannot cancel buying of, for example, coconut futures with selling of copper futures. You cannot have different products. You need to have the same products. So you just do the opposite position, or you just take the opposite position. Same way, another example means another indication. Sellers of a future contract buy another future contract. So what you do, here you sell and opposite you take a buy position, automatically the contract gets closed. Please remember, I have already told you, the future contracts, if it is a buy or a sell or a buy, it has to be of same characteristics. You cannot take different contracts and say I am reversing. It is not possible. What are the functions of a future markets? So just now what we have understood in the initial phase is, what do you mean by a derivative? What are the different derivatives available? In that, what do you mean by currency futures? More importantly, what are these futures? How do they operate? And now, what are the functions of that future market? There are broadly three functions. One is called price discovery. Another one is called speculation. Third one is called hedging. And for your information, normally the three things are applicable to stock market also. But since we are talking about future markets, we want to give more emphasis on that. Price discovery. What is this? Okay, I'll just give you one more information on price discovery. Price discovery means by buying and selling the new prices are either discovered. So for example, I am just giving you a simple example of stock market. For example, there is a stock called Tata Power. So what we are expecting, the company is going to grow high. So automatically what we will do? Come on, we all start buying. When all of us started buying, the price slowly increases. That is actually price discovery. Because the company was not expecting, which means the market has evaluated one price. For example, 95 rupees. Now people around the market are having positive speculation. What does that mean? The Tata Power is going to do well. They are going to have foreign contracts. Now they are going to revolutionize the entire power industry. So all people are expecting the prices will go high. When this expectation is positive, we all start buying this share. Why are you buying this share? Because the price now is low. So when the price increases, by the time if you have the stock, you can sell and make profit. That is the reason you are into stock market. So all of us, including you, me, my friend, your friend, all of us are buying Tata Power shares. So we all bought shares. Automatically what happens? The demand increases than supply. The price slowly increases. That is price discovery. Same way, let us take a reverse situation. Let us take an example of ITC. ITC is somewhere, the stock price is somewhere close to 325, 326. So if you try to say, okay, ITC, there is some government regulation, there is some issue. So I am doubting that whether they can continue in the cigarette industry and all those things. So people are having a negative speculation. So what do? 325 is a big price. Let me sell it off. So myself, yourself, your friend, my friend, all started selling the shares. Not only 4 of us, the entire stock market people are talking about a negative trend. So the price, what we do when we sell more, supply is greater than demand. Why? We are all selling the shares. The people who want to buy is less. So what will happen? The price slowly comes down. That is also a price discovery. Now, price discovery doesn't mean that going up and going down. It is trying to discover new prices through demand supply functions or market forces. That is one of the most important function. That is what every investor has to be rational. Because please do not believe me. Just because I am selling, you need not sell. Don't have that panic thing. Think, understand, evaluate and then act. If somebody is jumping from the 7th floor, please do not jump. There could be different reasons for him. So you have to analyze, you have to execute. That is what the so-called brain is. We have to think and act in the right manner. That right manner will help us to give a better prices, or you will be able to discover better prices in futures market or in stock market. That is the first function. Second is speculation. The focus is very clear. What is the focus? Come on, I am coming here to make profit. How do you make profit? By taking some risk. So what are you doing? You are betting. It is not actually, the word is not correct, but still for easiness I am just giving you. You are betting on it, expecting that this stock will do well. And you are putting the risk. When the price increases, you sell off. You don't have any affection. You have heard about horse races? That is exactly people, what do? They do is betting, or you try to speculate. So you fix a price that if this horse or this jockey wins, automatically I will be bidding for it. So legal sense, it is all fine. Here speculation is also one of the most important characteristic. Third one is hedging. Why do you come here? In order to minimize your risk. You are not maximizing your profit. Speculation is maximizing profit by taking risk. Hedging is minimizing risk by taking correct positions. So you will be taking, we will come to this in detail, but right now hedging, you are trying to minimize risk, not maximize profit. You don't want high profit, but you want to have minimum losses. So 3 functions of a futures market. Yes.